Job openings fall to the lowest level since February of 2021. And this is actually good news for the economy and also for potential Fed interest rate cuts. And here are the specific numbers. Job openings fell in April to their lowest level since February of 2021 as the labor market shows further signs of cooling off from the hiring boom that followed the US economy reopening after the pandemic. After the pandemic, people had a lot of savings because they didn't go out and do stuff, and they also had a lot of money from stimulus that the US government gave out. So after they got out of quarantine, everybody was able to start spending that money. And because they were spending that money, all the companies started hiring because a ton of people were pumping US dollars back into the economy. And this led to people switching jobs because companies needed people in order to handle this influx of money and the outflow of products. And so they were willing to pay more and more to fill those job openings. So people started job hopping so that they could get better and higher salaries. And so wages skyrocketed because these companies were willing to pay and bid up the prices that they were willing to pay for employees higher and higher. And that led to inflation. And we can actually see this in practice if we go over here to the Fred data, employed full-time median usual weekly earnings for people who are 16 and older. The first spike here is as people quit a bunch because a lot of people were either unable to work or were getting stimulus checks and going on unemployment, which meant that there were fewer employees for things like tech, which was absolutely blowing up. And then as people started to get rehired and things started to slow down, the wages went back down. And then they've started spiking again here up until very recently when they've dropped. But this spike has been pretty significant as well because people are job hopping because there are more jobs than there are people actually looking to fill those jobs. And you may remember this great resignation as people were just quitting and employers were physically unable to fill all the roles they needed. And as a result of that, they had to bid up wages. Now, as for the specifics of the jobs report, CNN reports it here. The number of job openings in the US shrank for the second month in a row, setting a new 3-year low amid further signs of cooling in the labor market. There were 8.06 million available jobs posted in April, according to the Bureau of Labor Statistics' latest job openings and labor turnover survey, the JOLTS, report released on Tuesday. That's below the downwardly revised 8.36 million seen a month before and the lowest since February of 2021. Economists were expecting job openings to register 8.36 million according to FactSet estimates. As of April, there were an estimated 1.2 available jobs for every job seeker. So there's still more jobs than there are job seekers. That's the lowest ratio since June of 2021, BLS data shows. And that's a good thing. We want there to be basically one job available for every one person that's looking for a job because that will keep wages from spiking too high and keep inflation from spiking too high. If there's too many openings and not enough workers, companies will pay more to get those people. But as a result of that, they're going to raise prices because it's a zero-sum game and they've got stocks that they need to keep going up and up and up. And as a result of that, they'll raise their prices, which raise prices for everybody. A lower number of openings, as you can see here, 8 million, means that companies aren't having to bid up wages quite as much, which means they're not going to be raising prices. And we've seen this at places like Walmart, Target, Aldi, and some other companies who have actually been lowering the prices of their groceries and their goods because consumers were pulling back and also because they're not having to pay as much to get new employees. Now, the question on everyone's mind is, with this new JOLTS report coming out, is the Fed going to cut interest rates? And the answer is probably not. The short of it is here from this MarketWatch article that says demand for the labor has cooled off from very high levels, but plenty of companies are still hiring. The Fed would like to see hiring slow even further to help ease upward pressure on inflation. The economy is still adding far more jobs each month than the number of people that are actually entering the labor force. Basically, the data is good, but probably the data is not good enough. And this is something that economists in general are agreeing with. Here, Market Insider talks with the economists, and this is what they say. US lead economist Nancy, whatever her name is, said the decline in openings signal a slower pace of hiring in the months ahead. With layoffs remaining low, net job growth should continue to be positive. The unchanged quits rate is at a level that is consistent with ongoing moderation in wage growth. The economist added, the Federal Reserve will welcome signs of a cooler labor market conditions, but the JOLTS data doesn't change our view that the Fed will be content to keep interest rates at the current levels until September, Van Houten said. The labor market remains healthy enough to allow Fed policy's decisions to be primarily guided by readings on inflation. April data on inflation was encouraging, but the Fed needs to see more than 1 month of good data before lowering interest rates, and this is agreed with by these capital economists. North American economist Thomas Ryan said the April JOLTS data provide further evidence of normalization, with job openings falling further, layoffs still at historically low levels, and the leading indicators all pointing to wage growth cooling. So it's not bad news, but it's also not news that is good enough to really impact the Fed's meeting and make the Fed lower interest rates, at least until September. So what this has done is basically solidified the fact that interest rates are going to remain unchanged until at least September, when they might be dropped 0.25%, but we don't know that for sure. We will need to rely more on inflation data as it comes out and see where that leaves us. Thanks for watching.